Good evening, everyone. Good evening, good evening. Welcome, welcome, welcome. It's another Tuesday. And so I welcome you once again to our regular Tuesday webcast. So, of course, David, by now I know most of you would know that. David from Etienne or of Etienne Business Solutions. And you are at our place that I call Etienne's Place. Etienne's Place. And so I welcome you and I thank you for joining me this evening. Again, reminding you, you can always check out our YouTube video, Etienne's Place, exact same name, Etienne's Place, and check out the videos that we have posted. Like, subscribe, make your comment, share, and just be informed, be empowered. Jumping right into the subject matter for today. For the past couple of weeks, we have been addressing the whole topic or concept of costing, and cost management. Basically, the major focus by the average business person, especially us small business operators, is that we always seek to see how can we increase the top line, which is the revenue. What do I need to generate more revenue? What can I do to bump up my sales, etc.? And that is good, that is fine, that is what ought to be done. Sometimes we tend to overlook or not spend enough time focusing on the cost side of things. Because remember, at the end of the day, our profit position is a direct result of our revenue on the one hand, and our cost on the other hand. So while we're trying to bump up the revenue, which is what ought to be done, we have to be cognizant of the cost side. So we have been spending quite a bit of time, and we looked at variable costing some weeks ago, and we related it to break-even analysis. Then we went on and we looked at standard costing, and I related it to budgets and variances. Today we want to jump right into process costing. And I'm relating process costing directly to transfer pricing. Okay, not by any means implying that these cost methodologies are only applicable to those things that I mentioned. Just a matter of bringing relevance to them, so you can see exactly, get a sense of how the thing actually works. That's why I'm linking them. So today we look at process costing, and we link it now to transfer pricing. Good. I actually want to start off by looking at transfer pricing, and then we link it back to process costing. So transfer pricing, simply put, we're saying that if we have a product that we're manufacturing, product called X, we're manufacturing that product, then of course costs of labor, material, you name it, whatever, will go into making that product. Okay? At the end of the day, we'll be able to ascertain what was the true cost of manufacturing one unit of this product. And we manufacture it so that we can sell it to make some money. So we want to transfer the finished product out of our factory, out of our plant, and to the public for sale. And we want to determine, okay, how do I determine the price at which I should sell this product? Now, there are a number of variables that goes into determining the price that we sell at. But one of those things would be, at minimum, we want to ensure that we have covered the cost of production. So even in that simple way, the concept of transfer pricing is basically talking about looking at how we put together all the costs that go into the manufacture of a product. And once you know that cost, then we can decide, I want to make a 10%, 5%, 20% markup, or loosely speaking, profit. So if the thing costs me $100 to process, then I want to say, okay, if I want to make a 20%, whatever, then I'll say I'm going to sell it for $120. So by knowing my cost, I can then decide on at what value, at what figure, at what price I am going to transfer this finished product from factory to the public by way of sales. So that's a basic understanding of transfer pricing. Let's now look back at process costing and then marry the two, process costing and transfer pricing. Process costing is usually used as a costing method in a manufacturing concern, where you have a product being manufactured and it goes through various stages. We're going to use a very simple example today. I'm looking at the manufacture of chairs. I'm just going to focus on one chair because whatever applies to one chair is going to be the same thing that is applicable to 1,000 chairs, just one times whatever. So one chair. And we're going to keep it very simple. The three components of a chair for our purpose here, the three components are the seat of the chair, the backrest of the chair, and the legs of the chair. Simple. Three components of this product called chair. Yes, it is true that with the simplicity of producing a chair, we may find that the whole chair, the total chair, may be manufactured on one point at one location. But consider a large manufacturing concern that produce a lot of furniture, distributing all over the country, all over the world. Then they would have a huge establishment making chairs. And so for proper management, for streamlining operations, it may be wise for them to say, we're going to break down our operation into separate production departments. So department A, you focus on seats, chair seats. Department B, you focus on chair back, the rest. Department C, you focus on legs. So we have three distinct departments. Let's also assume that for whatever reason, for efficiency or otherwise, it is decided that we best manufacture legs before, as the first step, to be followed by the back, and then third, the seat. Okay? The experts say, this is the most efficient way to utilize your space and to streamline the flow of the work. So they've decided legs first, backrest next, seating last. A, B, C. So those are three different departments. And so as you can understand, the first department will now get material, labor, and all the necessary inputs that will go into the manufacturing of legs. Okay, that's process one. So process one is going to accumulate all the necessary costs to be able to manufacture legs. And we're just using a single chair for this analogy. So the 4 legs for this one unit of chair. Once they have done that, they now need to move, because the manufacture of chair is all they exist to do. So their finished product is 4 legs, 4 complete chair legs. That's their finished product. And they will have to pass it on now to the next department, department B, who will now take those legs and start to fit up the back and be able to attach the back of the chair with the legs. But they will now be manufacturing backrest to do with legs. And so it moves to B. But if you notice, at the time that it started in the first process or the first stage, that is where a lot of costs were accumulated. Board to beat the back, the legs, the sanding, the labor costs, etc., etc. So those costs were incurred. Let us assume that the total cost incurred to have 4 finished chair legs was $100. So the cost of department A is $100. They move it on to department B. So they are transferring their finished product to department B. And for department B, that is their opening raw material. When I say opening raw material, they are taking this thing and they're going to now do further work to complete a chair. So they take the legs and then they're going to look about preparing backs, etc. But the point I'm trying to emphasize here is that Department A had incurred some costs. And by transferring chair legs to B, it is transferring not only a physical product, but it is also transferring a cost. The cost incurred thus far is being transferred to B. So quickly, B will now work, make chair back, and it will have to incur its own cost. So let us say that it incurred an additional $60 to prepare the back of the chair. So at the end of the second process, which is in Department B, the total cost so far would be $100 from Department A to do legs, transferred to Department B, where another $60 was added on to the overall cost of production to complete backs. So far, at the end of process B, we have accumulated 100 plus 60 equals $160 worth of cost. Okay? So process 1, $100. Process 2, $60. Then, finished product, we move it now to the third department, which will be the third process, where the seats are going to be manufactured. And I'm going to assume that the costs to do seats is just $40. So 100 in step 1, $60 step 2, $40 step 3. So at the end of the process that involved 3 distinct departments, I end up with a total cost of $200. $100 legs, $60 backrest, $40 seat. So the complete item unit of chair cost $200. But what is key here is that we are able to break down the cost into components, not just in terms of input components, but in terms of departmental costs incurred. Good. Let us say, for argument's sake, that when the chair is completed and it has now a total cost of $200 embedded in that chair, for us, when our normal markup profit that we want to make on the chair is, say, like maybe 20%. So if the thing costs us $200 between beginning and end of process, then we say, you know what, 20% of $200 is another $40. So we want to make $40 on that chair. So we're going to sell it to the public for $240, which will cover our $200 cost and give us a $40 profit. So in our minds, follow me now, in our minds, our decision was taken to set the profit that we want to make in percentage terms. It's just that the 20% end up working out to be $40, 20% of 200. But the system or the decision was to say, set it that we make a 20% profit on each chair. What if for whatever reason, the next time that we produce a chair, we find that instead of it coming out at $200 cost, this thing came out at $300 cost. Now, remember, the company has decided we want a 20% profit on the cost of chair. Now, if the total cost coming from all 3 departments equates to $300, then 20% of $300 is $60. So for the company to still realize a 20% profit, it will now have to add $60 to the $300, and said for $360. Now, if the market and consumers are willing to accept it, cool. But let us say that all the competitors around are charging anywhere between $240, $245, $250 for their chairs. And you coming to tell the public that, oh, my chair is $260. Hey, unless your chair is of a superior quality, you may find that you're in problems. So management will now say, oh wow, no, we need to look back at the production process. How did we, in this period, end up with a total production cost of $300 when normally we have it at $200? Because Department 1 normally incur 100, Department 2 incur 60, Department 3 incur 40, or the other way around. But at the end of the day, it always amounts to a production cost of $200. Now, it would seem that if the market is not willing to pay $360, then the company may have to cut its profit margin from that 20% down to 15, 16, 14%, so as not to end up charging the consumer a price that they will reject. But before doing that, they want to look back at the production process. And that is important because you can now go back to process 1. Normally, you have $100 what you incur to produce chair legs. Let me look at what happened this period. Same thing with Department 2 for the backrest. Same thing with Department 3 for the seating. And by so doing, you'll be able to identify, you'll be able to isolate that department, that particular stage in the process that contributed to the increase in the overall cost from $200 to $300. So instead of looking at an overall picture and say, wow, ooh, how did that chair end up costing us $300 to manufacture? No, you can drill down on a process basis. Which of the 3 processes had an overrun? And once you say it was, oh, okay, it was Department B, it was the backrest people, then we need to investigate the backrest people. Let me look at your production process and whatever, and your input costs, etc., to identify what in this period would cause step 2, production B's operation, to have a cost overrun that results in the overall chair price moving from $200 to $300. Okay, so you can see right away how crucial and well, very practical and useful this whole process costing is. Let's now link that to transfer pricing. It is true that in a manufacturing concern, most of the independent, I'm calling them independent, or discrete, most of the discrete departments, again the A, the B, and the C, they are usually referred to as cost centers. Simple, because all they do, or they are meant to do, or they are designed to do, is to incur cost in order to have a particular output, transfer this output with the cost including it to another department. That department adds some more cost. So usually the different stages and departments in a manufacturing concern are usually what we call cost centers. Okay? So because they are cost centers, the primary objective with, as far as these centers are concerned, or these departments are concerned, is to see how best to control costs. If you notice, they are not in the business of generating income. They are in the business of incurring costs, and proper management of such a department that is a cost center is in looking at ways to manage the cost of each department. Let's bring in the whole concept now of transfer pricing. Although these departments are meant to be cost centers, some companies decide that, I want to see a bigger picture of department A, B, and C in terms of their viability. So yes, one of the measures is to see how well they control the cost. But the company could decide on a way of doing things where when Department A is transferring to Department B, it transfers it at a transfer price. Meaning that Department A is saying, once I have incurred $100 worth of cost to prepare legs and I'm transferring it to department B, I want to get a transfer price attached to it. So I am going to transfer it to you guys at $110 so that I will make $10. This department will recognize or realize $10 above the cost it incurred. So the cost of legs, $100. It transfers it to department B at $110, and so it makes $10. Now this is all internal, but it's more to look at the viability of the departments. Same thing, department 2 or department B will do likewise. They add on their $60 or $40 for the chair backstage, and when they come up with that cost, they have to send it on to department C. They will transfer it to at a price that is cost plus whatever little markup management or the company decide is to be charged, between departments. So by the time the chair is completed at the end of process 3 in department C, department A would have incurred some cost and make a little money by transferring it at cost plus a little markup. Department B, again, complete his phase, transfer to department C at cost plus a little markup. Now, department C is holding the real finished product, a chair, ready to go to the public, ready to be sold. So in that chair, as far as cost is concerned, in that chair, there are 5 elements of cost up to this point. And department C is now going to add on the last piece, which is the 6th element of cost. Let's see what are the 5. Department A incur $100 as cost, transfer to department B with a little added $10. Cost plus the added figure at which it transfers it to B. B incur cost and then add a little thing onto it to transfer to department C. C incur its own cost, so I'm going 5. And now it as a finished product ready to go to the next step. It's just that the next step now is not another department, it's actually for sale. So now C is at the level where it is going to determine at what price, what is that little additional piece to add as step 6, which will now basically identify the cost or the selling price of the product to the public. So then, and yes, it's a manufacturing lineup. So once step 3 or stage C is finished with it, it will be sent out to the sales department or whatever they do. So at that point, as I said earlier on, if it is coming out that that cost is a little unusually high, then you will find that 6th component, right, which is that final added on piece of money to determine the overall price, may be a little iffy. It may be a case where, for us to make that 20% required overall profitability, we need to do. But given that the cost has been a little higher than usual, can we still do a 20% to the public? Or do we have to cut it down to about, say, 15% or whatever? That's a decision to be made. Now, if it was a case where Department A did not charge a little profit when it was transferring to B, Department B did not charge a little profit when it was transferring to C, it means therefore that it will be left at the end of the 3rd phase, which is where C is at, to determine what to add on to all the costs coming from A to B onto C. Note, if A did not add on a little transfer price, but just transfer it at cost, B did not add on a little bit for transfer price, but just did all at cost. When it comes to C, C would now add its own cost, and so you would have a finished product that all it has contained in it, right, is just costs. Cost incurred by departments 1, 2, and 3. It is now that they're going to think of a real transfer price. Know that we have a cost of $200. Because we want to make 20% profit, then we're going to transfer it to the public by way of sales by adding on our 20%. If it's a case where each department was adding on their little piece, you're going to find then that that final figure that is added on by C, when you add C's little piece of profitability, B's little piece of profit, A's little piece of profit that they all added on, then that piece plus this piece plus that piece will all total to a 20% markup, which is what the consumer will pay in addition to the cost. Because in this case, it is left to the final step, the completed product, to determine the price to the public. So it's going to be the total cost coming forward plus the markup, that's the selling price. In that case, we would recognize, as we said earlier, that A would strictly be a cost center. Just cost, you're just incurring cost. B, strictly a cost center. C, strictly a cost center. The final product now is sent out to the sales department and they decide, okay, among those 3 departments, they incurred $200 worth of cost to manufacture this chair. Let us now work out the numbers to see, because we want a 20% markup. So we're going to transfer the thing to the public at that. So if you notice, this whole concept of transfer pricing is something that can be done internally, or it can be just left to the final phase. We spoke about cost centers because usually these manufacturing stages, processes, departments are really cost centers. If they continue to be cost centers, it means therefore that when the thing is finished, it has accumulated all costs. When it goes to the sales department, they will now work out the revenue side. And so those departments over there, I'm calling them, are really the profit centers. Why? Because they are taking the costs to this point. They are determining the markup to be added. They are then selling the product to the public. So if you notice, they have 3 components. The cost is they have received it. They determine the markup and, sales, whatever, send it out to the public. So in those departments or in that sales department is where they will have all the components that is needed to determine profitability. Selling price, cost price, profit. The difference between the two. So those are profit centers, whereas these guys in the production process are cost centers. Cost centers. Now, backing up a bit, it is true that, I always say that, small operators, and I put small operators in quotes, small operators, even in a manufacturing concern, for example, you may have, a guy who is doing, still in the furniture business, he has quite a good business carrying on and thing, but he doesn't necessarily go to that meticulous details to say, okay, each stage of production, what's the cost involved here? So that if there's a cost overrun, I can analyze each stage, each phase to see where my cost overruns are. A lot of smaller businesses don't do that. But it is a normal, integral part of large manufacturing concerns. Okay, that is why these large companies, when they have their accountants, yes, you have financial accountants who deal with, balance sheet and profit and loss and cash flow, but then you have cost accountants. These cost accountants are the real numbers crunchers, right? Numbers crunchers, because they will always look at every step of the process. What's the cost of labor? What's the cost of material? What's the cost of whatever overhead? They meticulously go through to ensure that they are controlling the cost, and not just on an overall basis, but step by step. Because the minute costs get out of whack, they want to quickly identify what's the reason for this and take remedial action. So that is process costing. Process costing. Now, if I to bring this home now to our small operators, yes, no one is expecting you to take your simple little shop floor and put up a partition here and a partition there and say this is stage 1, 2, and 3. And Tom, you work stage 1, Jack, you work. No, we're not really asking for that, because by the nature and the scale of your operation, it may not be, optimal to do that. It may not be necessary. However, at minimum, on paper, we should identify that to produce this unit, yes, there's an overall cost, but you can always identify components of this thing and the related cost for each component. And by doing that, you're able to manage and monitor and track the cost, not overall in a general sense, but more specific to this and that and that. Let me give you a simple example. Let us say that you are into providing natural fruit juices. Oh yeah, natural fruit juices. Let's take that for example. You may say, okay, how can we break down that into a process? But it is simple, because you are going to have inputs. Yeah, orange, pineapple, grapes, you name it. You're going to have all those inputs there. Now it is possible, follow me, it is possible that you would buy fruits in bulk, and at one stage, at the beginning, you blend it all to make a puree. That's what it's called, I think, a puree. And you're going to make gallons and gallons and gallons of puree, even ahead of your full production process. And then, at a different point in time, you're going to take some of the puree, bring it here, and people are going to now take the puree, add some other ingredients and components, and move it from puree stage into a concentrated liquid stage by adding some other things to it. Okay? Still not ready for consumers to consume. Then you have another step where people are going to take now this concoction and are going to now do some further thing to it, making it ready for bottling. When it is now bottled is when it's going to be sent out to whosoever is dealing with selling juice. So if you notice, yes, we're just doing fruit juices, but there are 3 distinct steps. And each of those steps have identifiable costs associated with them. And once that is possible, it is possible for us all to track it. Let me make sure that this guy, when he's buying these fruits from farmers market and whatever, he's being very price conscious. So that when he has gallons and gallons of puree, it is gallons and gallons of puree within a certain cost framework. When this guy takes some puree and now is going to thin it out, put whatever preservative, I don't know, whatever they put to that, okay? He's going to also incur additional costs. Let's ensure that this guy, he's not just taking up puree and just splashing it all over the place and it's all over the table and etc. No, he's very cost conscious. Good. So he has now transformed it into this thick thing, into the more, drinkable, but still not ready for consumption. Then the other guy is going to take that now and do the final process and have it bottled up, etc. So you're able to look and ensure that everybody is doing what he or she ought to do and doing it in a very cost-conscious way. So this whole concept of process costing and related transfer pricing, yes, is used by large entities at all times, but the principle, the discipline, okay, the value added from tracking your cost is available and should be utilized by just about any small operator, especially if you are in a manufacturing production type process. That's it. So if you notice, we had looked at variable costing way back, and we had focused on the whole importance of break-even analysis. Go back and refresh your memory on that. If you want to check out, it's all there on my YouTube channel, Etienne's Place. Go and check it out. See how your operation can benefit from that. We then moved on to standard costing, where we look at setting standards and being able to identify where there are fluctuations or variations in our actual costs compared to those standards that we had set. And then we can determine whether or not we need to make some budgetary adjustment or we need to just do something else. Then today now we look at process costing, where we're saying, yes, it is one big manufacturing room, but no, it can always be subdivided or broken down into smaller components where costs are better identified, better managed, better analyzed, and better rectified. And at the end of it all, we spoke about transfer pricing, where yes, the end result will be transferred to the public for sale. So the final transfer price is really the total cost plus the markup is the selling price. But more than that, you may find that companies or entities decide we want to have what I refer to as an internal transfer price system. Okay, so that each department actually see a little compensation, for its effort. I'm calling it that. That's basically to say, okay, I'm giving it to you at this, that. And so that's the system there. Very, very important. So that's it for me for process costing and its related transfer pricing. Costing, very important. At the end of the day, people, if we could find a way to just increase revenue, increase revenue limitlessly, then maybe cost and cost management would not be such an issue. But you and I know, especially now, based on the state of the economy, you can do all that you try to do all that you can to boost your revenue. But hey, the reality is such that it's going to reach a point where nothing more is happening. Okay? So if you want your bottom line to improve, since the top revenue figure is kind of still right now, not moving anywhere, we need to find ways of managing the cost. Because if this revenue stays static and we can find ways to reduce, control the cost, then obviously the resulting bottom line, which is our profit, will be positively impacted. That's me, David Etienne of Etienne Business Solutions, certified public accountant, business consultant. Check out our YouTube page, Etienne's Place, and I invite you to subscribe, because you will definitely find it worthwhile to be alerted when we're coming up with our new stuff. And go back to the channel, check it out, share it, leave a comment, and just binge on all the videos we have there, because it's a wide range of subject matters, business subject matters that we cover. So once again, I'm out of here, and David's saying have a wonderful rest of the week, and we will be back here next Tuesday for another webcast. Stay strong, work hard, God bless.